Hello, everybody. Welcome to the first week of Cost Accounting, Accounting 203. This is going to be a 16-week class, and we're going to be going over basically cost accounting and just different things related to that. The book that we're going to be using in this class is going to be the 16th edition of Holmgren's Cost Accounting, a managerial emphasis on accounting. And what you need to do is make sure that you get this book plus the My Accounting Lab software. You can buy just the Accounting Lab software that does have the textbook online if you want to. That's good for you. All your homework and your quizzes and your tests are going to be taken through My Accounting Lab. We're also going to have a book report, and it's going to be on Extraordinary Circumstances by Cynthia Cooper, and it's about the rise and fall of WorldCom. It's a very interesting book. It basically goes into how that company built itself to one of the top companies in the world, and then the downfall of that company. And Cynthia Cooper is actually the person who reported the misdeeds of the company to the government that led to the bankruptcy of that company. So it's a really interesting read. Your discussions every week or every other week are going to be about that book report or that book. So basically you're going to be reading about 5, 6, 7 chapters every 2 weeks. It is a very easy read, at least it was for me when I first read this book. So just keep up on that. And then at the end, we're going to have a book report. And it's very, very simple. I'll be giving you a document asking specific questions about the book. So it's not your traditional book report that you usually have. So that is good for that. So if you have any questions about those, you can just call or email me, and I'll be more than happy to talk to you about it. At any time, if you have questions during the class, please do not hesitate to ask. Just shoot me an email. In My Accounting Lab, there should be a button somewhere that says Ask My Instructor, and that sends me an email and says, hey, we have a question about this, and I'll get back to you on that one. So today what we're going to be doing is talking about Chapter 1, the manager and the management accounting. And you can find these PowerPoints out on My Accounting Lab. So if you want to print them out and follow along and take notes, that would be great. Or, of course, just follow along in your book, too. It pretty well follows the book along. Some of our learning objectives is distinguish financial accounting from management accounting, understand how management accountants help firms and make strategic decisions, describe the set of business functions in the value chain, identify the dimensions of performance that customers are expecting of companies, explain the 5-step decision-making process and its role in managerial accounting, describe 3 guidelines management accounting follows in supporting managers, understand the management accounting fits into an organization structure, and the last part is understand what professional ethics mean to management accounting. When we're going through this, follow along. At the end of every one of these PowerPoints, there's going to be a list of terms. I highly encourage you to take those lists and write them out and find the definitions in your book and make sure you understand every one of those and what they mean, because you will be tested over those items. All right, so a lot of you are probably very familiar with financial accounting. That's what you take when you take Accounting 201, Accounting 202. Financial accounting deals with the numbers and putting them into reports. Management accounting, really what it does, it is looking at those numbers and analyzing what do those numbers mean. The official definition measures, analyze, and reports financial and non-financial information that helps managers make decisions to fulfill organizational goals. Management accounting need not be GAAP compliant. One thing you have to remember, financial accounting is always following GAAP. Management accounting does not have to follow GAAP. Financial accounting is really an external report. Management accounting reports are really internal report. We'll get more into that later on. Managers used management accounting information to develop, communicate, and implement strategies and coordinate product design, production, and marketing decisions and evaluate the company's performance. So basically, a good way to remember management accounting is you're looking into the numbers. What do they mean? Does it make sense to make a product? How much does it cost me to make a product? And is it basically you're using this to help decide how the company is going and if it should continue or it should not continue, and what does it need to do to continue? As I said, financial focuses on reporting financial information to external parties such as investors, governmental agencies, banks, suppliers, and it's always based on GAAP. Whereas cost accounting measures, analyzes, and reports financial and non-financial information related to the cost of acquiring or using resources in the organization. And that's going to be internal. So we're also, when we're dealing with cost accounting, we're also going to be dealing with non-financial information. And that basically means, could be like the environment. What type of environment are you selling in? Is it where people are spending money or are people holding back their money? Things like that. So you're not just looking at the numbers, you're looking at the trends of what's going on in the world and how does that affect your company. Today, most accounting professionals take the perspective that cost information is part of the information collected to make management decisions. Therefore, the distinction between the two is not clear-cut. In your book and these PowerPoint presentations, we often use the terms interchangeably. What this is telling us is when we refer to management accounting and cost accounting, we are referring to basically the same thing. All right, so here are some major differences between financial and cost. The purpose of the information. Basically, for management accounting, the purpose is to help managers make decisions, and that's going to be internal. For financial accounting, we are communicating our financial positions to people on the outside who care how we are doing, such as bankers, investors, regulators, and anybody who has a stake in our company. The primary users of management accounting are going to be your managers within the organizations. And in financial accounting, it's going to be your investors, banks, regulators, and of course your suppliers. Now, why would suppliers need to know what your financial is? And basically, that's because the suppliers want to know if you're going to be able to pay their bills. The focus and emphasis in management accounting, we are looking at the future. The management accounting, we're looking at, okay, should we continue to make this product or not make this product? Should we step into a new area of products to make or not? Things like that. What are we going to be doing in the future? Whereas financial accounting, we're always reporting on the past. How did we do? What kind of revenues did we have? What kind of expenses that we have? The rules of management, measurement and reporting. As I said earlier, management accounting does not follow GAAP. It is basically all internal, and no one on the outside of the company really sees these reports. Financial statements must be prepared, of course, according to GAAP, and they are certified by independent auditors. Now, on the management side, the auditors would never see these reports. Now, the time span and type of reports. In management accounting, we're not just looking at the here and now, we're looking into the future. So sometimes we could be looking at things 10, 15, 20 years in the future. We're also looking at non-financial and financial aspects of what's going on with our company. In financial accounting, we're of course looking in the past, and those reports could be just based on a monthly, weekly, quarterly, annual. So they're very condensed. They're not long-term. Behavioral implications on the management side, designed to influence the behavior of managers and other employees. So basically, we're taking these management accounting, we're analyzing the data, and that data helps us possibly like compensate the managers for a job they're doing, and give bonuses to employees and things like that. In financial accounting, the primary reports economic events, but also influences behavior because managers' compensation are often based on it. Strategic decisions in the management accountant. Strategy specifies how an organization matches its own capabilities with the opportunities in the marketplace. There are two bold strategies: cost leadership and product differentiation. And strategic cost management describes cost management that specifically focuses on strategic issues. Management accounting information helps managers formulate strategies by answering questions such as the following. So when a manager is looking at this information, who are the most important customers and what critical capability do we have to be competitive and deliver value to our customers? So we're looking at our customers. Who are our customers? What do they want? And how do we fulfill those wants and needs? What is the bargaining power of the customer? And basically what that means is there other items out there that are comparable to us? And can they get those items for a better price, or do they want to come here? What is the bargaining power of our suppliers? Again, are there multiple suppliers out in the marketplace, or are they the only supplier? And just how much leverage do they have in the business? What substitute products exist in the marketplace, and how do they differ from our product in terms of features, price, cost, and quality? So basically, what we do is we look at what is our product. Who else makes a type of product like this? Is it a better product? It is a lesser quality product? What is its price? Do they beat us on price? Is it more expensive? Or is our product something that people will pay for? Will adequate cash be available to fund the strategy, or will additional funds be needed to raise? So basically, we're looking there is how much is it going to cost to make our product? And do we have enough cash? And if we don't, how would we go about raising that funds to get the cash that we need to make the product? Now, the value chain and supply chain analysis and key success factors. The value chain and supply chain, we're going to be talking about that a lot in this class. So make sure that you understand what this is. Creating value is an important part of planning and implementing strategy. Value is the usefulness a customer gains from a company's product or service. The entire customer experience determines the value of the customer derives from the product. So basically is what kind of value does our product give the customer? Is it something that they are looking for, or is it something maybe they don't know they need, and when the product becomes available, they realize they want it? And how much are they willing to pay for that product? So the value chain has 6 items here that we talk about. The value chain is the subsequent sequence of business functions by which product is made progressively more useful to customers. The chain value consists of research and development, design of products and processes, production, marketing, distribution, and customer sales. This is one of the things that you're going to be talking about in your homework assignments. And you're going to have to take things and decide which bucket does a particular item, fall into. So when we're talking about research and development, I like to talk about, when I'm talking about this, I like to talk about Eli Lilly and the stuff that they have to go do to bring a drug to market. The first thing is, of course, R&D, research and development. Research and development would be when a company has decided they're going to make a certain product. So in the case of Eli Lilly, it'd be a decision to research for maybe Alzheimer's would be an example. And so they start the research and development and try to develop the drug that would help people with Alzheimer's. And then once that, they do the testing and things like that to see if the product works. And then once they get to a point where, yes, we have a viable drug that will improve the lives of those people who have Alzheimer's. We start the design of the products and the processes. How do we put out the product? How is it made? How is it put into a peel? And then, of course, how do we package the product and get it to production? Once all the design of the making of the product is done, then the product goes into production and goes on the production line. And then once the product is in production, we have the marketing team that comes in and starts making a marketing advertising campaign to bring out the the product to market. And then once that is in place, we put a distribution plan into place where how do we get the product from production to the people's hands. And then once we have the product in people's hands, the customer service, dealing with calls and questions about the product itself and how to use that product and things like that. Now, the customer relationship management, or CRM, is a strategy that integrates people and technologies in all business functions to deepen relationships with customers, partners, distributors. CRM initiatives use technology to coordinate all customer-facing activities and design and production activities necessary to get products to customers. Now, we have the supply chain analysis. Production and distributions are the parts of the value chain associated with producing and delivering a product or service. The two functions together are known as the supply chain. The supply chain describes a flow of goods, services, and information from the initial resources of materials, services, and information to their delivery regardless of whether the activities occur in one organization or multiple organizations. Example of the bottling company. Now, I'm a big ski fan. If you ever know what that drink is, it is a Mellow Yellow Mountain Dew type drink. And I love talking about this because it's my favorite drink in the world. And you can only get it in Southern Indiana. So those of you who are in Southern Indiana probably know what I'm talking about. I really wish they would get it up here in Indianapolis, but that's not going to happen anytime soon. So basically, when a ski is getting ready to be produced, the first thing that you have in the supply chain is going to be the suppliers of the ingredients of the drink, okay? That's the first thing you have to have. And then from the suppliers, it goes to the manufacturing of the concentrate. The manufacturer of the concentrate gets it all together and makes the drink itself. It goes to the bottling company. And of course, there's going to be suppliers going to the bottling company that's non-concentrate, would be aluminum cans or bottles or product. And then once it goes through, the concentrate goes into the packaging, and it all gets packaged together. It goes from the bottling company to the distribution company. And so that would be the people who take it from the bottling company, gets on the trucks, and take it to Walmart or Bilo or wherever it goes, where they're selling the product, the retail company. And then, of course, then I walk into the store and pick the ski off the shelf. And that's a happy day for me. So, but yeah, so that would be the supply chain. How does it get from the raw ingredients all the way to my hands to enjoy a nice, refreshing beverage? Factors. Customers want companies to use the value chain and supply chain to deliver ever-improving levels of performance. Several of the following: cost and efficiency, quality, time, innovation, and sustainability. Sustainability. Interest in sustainability appears to be intensifying among companies for several reasons. Some of those, more and more investors can care about sustainability. Companies that emphasize sustainability find that sustainability goals attract and inspire employees. Customers prefer the products of companies with good sustainability records and boycott companies with poor sustainability records. Society Non-governmental organizations monitor the sustainability performance of firms that take legal action against those who violate environmental laws. So basically what this is talking about is the company going to be there in the future to back their product? If it's a fly-by-night company, you don't want to invest or you don't want to buy that product because you're afraid it's not going to be around. You know, you have great companies out there that's been around for years and years. The Coca-Cola Company, John Deere, just to name a few that's been around a long time. They're doing well, and so they're going to be there to back their products. You know, the up-and-coming companies that you kind of question sometimes might be LuLaRoe is one that you kind of question now, whether they're going to be able to keep up the fad that's going on with all their clothing line. Do they have the ability to keep that going? Tupperware would be another example that back in the day, that was a very good company, you know, great products. They still have great products, but people are looking for more disposable stuff. So the Tupperwares might be having trouble. Are they going to be able to stay around? Even though they've been around for years and years and years, will they be around in the future? Not that saying they won't be, but that'd be something that you might look at. Making, planning, and control. 5 steps of the decision-making process. Identify the problem or the uncertainties, obtain information, make predictions about the future, make decisions by choosing among alternatives, implement the decision, evaluate the performance, and learn. This is something that we're going to be doing a lot in this class. You know, basically looking at what is the problem. For example, do we continue to make a product or not? The price of a product or not? Obtain information would be what our competitors are doing? What kind of costs do we have associated with this product? What, just things like that. Make predictions about the future. Is this product a product that is going to be wanted in the future, or is it going to become outdated in the future? Make decisions by choosing them alternatives. Basically, should we continue to make the product or not make the product, or can we cut the price, or do we have to raise the price? Implement the decision, evaluate the performance, and learn. Implement, so say we decide to keep making the product, and then, but we always want to keep up with that product to make sure that is a good decision. And if in the future we decide, hey, maybe this wasn't a good thing, we should stop this, then we go ahead and stop the product. Planning and control systems. Planning consists of selecting an organization's goals and strategies, predicting results under various alternative ways of achieving those goals, attain and desired goals, and communicating the goals and how to achieve them to the entire organization. Management accountants serve as business partners in these planning activities because they understand the key success factors and what creates value. The control part takes action that implement the planning decisions, evaluate past performance, and provide feedback and learning to help future decision making. The important planning tool when implementing strategy is a budget. A budget is a quantitative expression of a proposed plan of action by management and is an aid to coordinating what needs to be done to execute that plan. There are 3 guidelines to help management accountants provide the most value to strategic and operational decision making of the companies. The cost-benefit approach compares the benefits of an action purchased to the cost. Generally, of course, the benefits should exceed the cost. Behavioral and technical recognize, among other things, that management is primarily a human activity and should focus on encouraging individuals to do their jobs better. As managers use alternative ways to compare costs in different decision-making situations because there are different costs for different purposes. Organizations distinguish between line management and staff management. Line management is directly responsible for achieving the goals of the organization. Staff management provides advice, support, and assistance to line management. So basically, the line manager would be over a larger department, and the staff would be over a section of that department. So here's an example of organizational structure. We have the CEO, which reports to the board of directors. We have CFO, which is a chief financial officer. And under the financial officer, we have the controller, tax, treasury, risk management, investor relations, strategic planning, and internal audit. Now, the internal audit reports to the board more so because basically you'll learn a lot about that in extraordinary circumstances. Cynthia Cooper was in charge of internal audit, and that was one of the things she struggled in the book, was who does she report to, because people were trying to prevent her from, basically talking to, basically blow the whistle on what was going on. So the controller, they talk about global financial planning and budgeting, operations, administrative, profitability reporting, inventory, royalties, journal ledger, accounts payable and receivable, and subsidiary and liaison. Beyond the numbers, a successful management accountant possesses several skills and characteristics that reach well beyond basic analytical abilities. In cross-functional teams and as a business partner. So they're going to be working, management accounting doesn't just work in the accounting department with just the numbers. Interaction with all departments throughout the organization, helping them review their budgets and things like that. Fact-based analysis and critical judgments without being adversarial. What they're going to be doing is really trying to communicate what does the numbers really mean, not have that bully approach, condescending approach. They really have to have an open mind, remembering that the people that they're dealing with are people. They work closely with these products and things like that, and so they're very protective of those, and they have to have the ability to basically be able to work with those people and make them understand what really the numbers mean. Lead and motivate people to change and be innovative. So basically, again, have that ability to really talk to people, understand where they're coming from, and then have the ability to get their point across, and very influential with the people. And, make them understand that if they do certain things, their lives and jobs will be better for it. Communicate clearly, openly, and candidly. Be honest with people is a big part of management accounting. You can't sugarcoat things. You got to make sure that you are very clearly stating what is going on. Do not hide things from people. And of course, have high integrity. That's one of the things you'll learn about Cynthia. She's very, has a lot of integrity in regards to what they want. The 4 standards of ethical conduct in management accounting as advised in the Institute of Management Accounting are competence, confidentiality, integrity. We're going to talk about the Sarbanes-Oxley Act, which was passed in 2002 in response to a series of corporate scandals, which of course WorldCom was one. They focus on internal controls, corporate governance, monitoring of management, and the disclosure practices of companies. What this did was really put into more control about audits, how the company reports things, and of course penalties if they don't record things right. And then finally, the terms of to learn. Again, I would take these terms, make sure you understand each one of them and what they mean. If you have any questions about these, please do not hesitate to ask. I'm always here to help you. And we'll have a great semester about this. Each round will have a lot of videos. You can look at those to see if there's other active, items that you might not get in these presentations. So just explore that channel. It's Jane the Accountant on YouTube. have a great semester, and if you have any questions, let me know. Thank you and have a great day.